If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Hey, Dave, welcome to the show. Glad to have you here.
Thanks, Shawn. Thanks for having me.
Hey, it's always great when I get to talk to a fellow New Englander that invests in real estate. For whatever reason, when I do these shows, it's few and far between. I know there's a lot of us out there, but for whatever reason, this podcast cycle, I just don't see a lot of people. So it's good to have you on.
Yeah, bub. Do it from here, bub.
For those that aren't familiar, that's a classic Mainer accent. It's kind of funny. There's a different Vermont, New England accent, New Hampshire, Maine, and then everyone knows the Boston accent. So it's kind of funny. But good to have you on, and let's just get into this. So if you could tell the listeners a little about your background, about yourself, and how you got into real estate.
Absolutely. I got in late, but it's a better late than never, kind of story. Born and raised in Maine, middle-class family, never had any real estate ownership except for our personal house. Growing up. And, when I was in college out in the Midwest at Carleton College, I started studying architecture and green building. And I took a class on it. And then I ended up TAing that class for 2 more years. And so I learned a lot about it from a very hands-on practical standpoint of like, how do you build better insulation? Like, let's experiment, let's, install green roofs and see how they work and things of that nature that were kind of cool, back in the dark ages before television and color TV and all that. in the early 2000s, went down to South America after college and met my then girlfriend, now wife. We started a chain of camping stores down there, bookstores, and we were doing that for 4 years until we ended up coming back. I wanted to introduce her to, my home where I was from in Maine, and didn't really think we'd stay there, but it is just an awesome place in rural New England, as you, a fellow New Englander, can attest. So we ended up staying here. I went, got my MBA because, I had 10 employees in this spider web of Excel spreadsheets. I had no clue what I was doing. I had taken one econ class my whole life. And it turned out I just needed to know accounting, and a lot of business, I think, is pretty intuitive. You buy low, sell high, and, you want more income than expenses. That's not hard for anyone to grasp. But, I then worked in nonprofit leadership and fundraising, a small nonprofit helping kids in the Guatemala City garbage dump, and then Bowdoin College, where I learned kind of the finer points of development. But during those times, I had started real estate investing, because when my wife got pregnant, I was like, yeah, this nonprofit thing is not very profitable for me. And I'd like to be able to live a little bit more abundant life. I'd like to be able to donate to other causes that I see these, wealthy benefactors sponsoring. And, that seems pretty neat. And if I could do it with real estate, making it greener, making the world a better place, using renter money, to clean up fixed problems, that would be a really powerful thing. So I started out with just one single family home where I partnered, with family because they had money and I had extra time. And we just started rinsing and repeating. I started working with other investors, and fast forward to now, we're at 172 units, soon to be 190. Awesome. Done 5 syndications and excited to do some more.
Nice. That's a great story. And I love the part about, it's not just the fact that real estate, is a great investment, but it's also you can help the community by, fixing up property, providing the tenant with a better place to live, right? A place that they're proud to call home, proud to go home to. And we strive to do the same thing. That's why we love, value add opportunities, because not only you're going to get a great return for your investors, but you're also improving a community. And when you walk on property and they thank you, it's just such a great feeling. Go ahead.
I couldn't agree more. The feedback you get from neighbors, from longtime residents, from city, town officials, the fire chief, things like that. It really is gratifying. And so if you can both build your wealth, earn money, make a good career out of something where you're physically improving, your local community or other people's communities, that's a great opportunity. And it's worth learning all the technical jargon and ins and outs and cap rates and everything else to be able to move that needle.
No, definitely. So let's talk about so right now you obviously started off with that single family home. What did you continue that route, or did you transition maybe into multi or commercial? How did that happen?
Yeah, great question. I had this sort of simplistic vision that I would just buy like one apartment, the cheapest apartment I could in Portland. And I would do that once every 5 or so years. And then when, our daughter was 18, I could sell them and she could go to college on that, very kind of simplistic idea of just, yep, if I save, 10 grand a year, that's one down payment every couple of years and so forth. And that's fine for people that are not wanting to be on a fast track to anywhere. Slow and steady does win the real estate race as well. But did a second single family after that and started listening to podcasts like yours, and you guys inspire me. And I was like, learning about multifamily, I'm like, oh, like more than one unit, but only one roof, only one heating system, only one insurance policy, only one tax bill. Like those are kind of appealing. You get, efficiencies and economies of scale. So the next one I bought was a 3-unit building, which was right down the street from the college, Bowdoin College in Brunswick, Maine, where I was working at the time. And it was like a secret from all but my closest friends. So I felt like I was leading this double life, where I would on my lunch break, like hurry over and like help my contractor fix some, plywood or countertop or whatever, and talk to my tenants, clean up some garbage and then run back, go to my office job. And, it was a fun experience, a great learning experience too, because that building was 2 residential units and a commercial office of engineers. And I had no exposure before to a triple net lease. And my broker, who was a residential broker at the time, explained to me, he's like, Dave, they'll pay like their share of your taxes and insurance. And I was like, what? Tell me more.
Yeah.
So,
if not all.
Yeah, exactly. If they're a single, tenant building, they'll pay it all. And that can be very simple. So after that, I switched to working with a commercial broker who really specialized in multifamily and bigger properties, and, started working with other investors, who again had more capital they wanted to allocate. They trusted me, knew me, liked what I was doing, and were willing to give me, a small slice of the pie in return for helping them, grow their wealth as well.
Yeah, that's awesome. So now I just want to make sure I'm getting it right. So now you're focusing on multis, mid to larger size, and then also triple net commercial. Is that correct?
It's an interesting thing. I have always been a sort of interdisciplinary dabbler, a jack of all trades, if you will. And I'm that way in real estate. So I would describe myself as opportunistic.
Okay.
If you bring me a screaming hot, great industrial deal that kind of fits our values and our market, like, yeah, I'll go for that. I'll bite on it. It's the one class of real estate I think I don't own is like industrial and like hotel and hospitality. I think I've got all the other boxes, checks of restaurant, office, a bunch of different things. Right now, like we are under contract on a residential property. And I think multifamily is kind of the safest, solidest way to go, but it's also the most competitive pond to fish in. The smaller the unit count, the more competition you're probably going to have. And it's simple. And again, like because residential and multifamily are so simple, you're up against a lot of competition, and there's not quite as many ways to drive NOI and turn something around. As mixed use, it scares a lot of the folks away, and you're not competing against as many people. So if you're able to kind of figure out office leasing or restaurant leasing or some of these other fields, you can get great deals. And a lot of times it's a covert way to build up multifamily, because a lot of buildings in small downtowns or large ones in America, you've got, commercial on the bottom floor, and then you might have office, and then you might have residential up top. And so a building might have, 10 residential units up over a couple commercial units. And if you're willing to kind of figure out the commercial units, you can get all the residential units. Then you've got diversification as well. Some of your leases are 5 and 10-year leases. The residentials are probably ones. So it's a great thing if you can learn that game and tolerate that different element.
No, that's a great point. Go where there's less competition, not as of a red of a sea, right? And it's funny, even within multifamily, there's different levels of competition. Like you mentioned, probably the 1 to 4, super competitive because, anyone can get in. That's a residential loan. Obviously price point's a lot lower. And then I would say probably the 5 to 50 or 60, it's not as competitive because you got people that, they're stepping out of the 1 to 4, but it's not like all the commercial buyers, because then you get to like 100 to 300, then it gets really competitive again, because that's like when you're talking about scale and you can actually afford to have not only property management, but on-site staff. So that's like the first level of that. So that gets super competitive. And then like 300 plus, it gets less competitive, right? Because those are bigger players, because you're talking about 30, 50 plus million acquisition, which is funny that it's just within multifamily, there's different levels of competition. But I wanted to ask you, since you're being opportunistic, which I think is awesome and also rare, and I believe in this market, when you're going into maybe a new asset class, say, you start off single family, multi, that like residential, and then you're going into office, restaurant, or retail. When you go into that new asset class, are you going by yourself, or are you partnering with someone that maybe has had some experience in that asset class?
Great question. And in real estate, you never want to be the smartest one in the room or on the team. I'm often the least experienced, or the least intelligent, of the people I work with. So to answer your question, yes, I definitely seek out friends and support. It doesn't mean that I'm not, operating that property with my management company. I mean, I started a management company with my best friend from grad school, retired Navy lieutenant commander, and he's in charge of all the operations. And we manage restaurants and offices and retail stores and everything in between. But we do it by studying, the best practices. We talk with the brokers, we talk with the owners, and ultimately it's not that different. It's ultimately like a tenant is paying you rent every month for space. And there's different ways you can arrange the terms of that. And those terms are just so incredibly important, because the appraiser, they don't really care about, the building, the physical structure as much in commercial. They care about the leases. They want to see the cash flow and the money coming in and what's going to come in, in the future years. So that's kind of the beauty, is that it's a very, there's a lot more art, I think, than science in commercial, because it's such a people-based business, and it's about who who you can help, bring into your building, attract to come be a great renter, your reputation, things like that. It's much more important than just like, 4-unit apartment building in a good location, so we'll just fill the 4 units at the market price, boom, done.
Right, exactly. Yeah, in residential, it's underwriting the property in the market more so than where in commercial, it's underwriting the underlying leases.
Exactly.
So like,
is your tenant credit worthy?
Right. So if you're buying a property that only has like, say it's even just one tenant, and they only have 1 to 2 years left, that's, you're going to get tougher terms than if you had a tenant that had 5+ years left on their lease and they're a high quality tenant. So yeah, I agree with, I personally haven't gone in that space, but I can see how it's more of a, art, and that's what my question was stemming from. I'm sure the acquisition side is similar enough, but the leases is completely different.
Yeah. And going with a single tenant building is usually, I would describe it as a high risk, high reward situation. And you want it to be low risk, obviously. And sometimes if you have a big national credit tenant on a 20 or 30-year lease or something, that might be low risk. But right now, one of the biggest risks is inflation and rent increases. And I passed on a building in a phenomenal location in downtown Portland that was hamstrung by the anchor tenant. Subway had a 20-year lease, and they had built in 2% annual rent increases into that lease. Well, guess what? Like, our market last year was, a 12% increase.
Yeah.
And there's plenty of years where it's a lot more than 2% that rents are going up. So you want to be very careful of looking at the implications of the long-term lease. Are there, option years, and can the landlord adjust rent to market at those option year cutoffs? Like, those are really key things to be looking at in commercial, because with residential, you're only going to make a big mistake for a year probably. And then after the year, you can adjust your rent accordingly. Whereas if you make a big mistake in commercial for 5 or 20 years, you've tanked the value of your investment in a big way. So it's very important to analyze those factors.
Yeah, I can agree more. And so you keep mentioning Portland. Is that obviously that's your primary market? Are there any other markets you invest in, or do you kind of focus on Portland and the surrounding areas?
That's a great question, Shawn. I've actually avoided Portland religiously up until a week ago, when I just got under contract on my first
hot market. I could see why you didn't avoid it at first.
It's been hot. Cap rates have been compressed. Cash flows are anemic, and it was really just an appreciation market for the past 15 years. I mean, you got great appreciation, but unless you got in pretty early, cash flow was elusive there, especially now that it has a rent control law in place. I've been heavily focused north of Portland. It's where I grew up. It's the towns I've lived and worked in, towns like Brunswick,
Yep.
Lewiston, Bath, Topsom, Yarmouth. Those are towns that, they're a tertiary or even less market, but that doesn't mean they're bad places to invest. And indeed, I've completely gotten lucky. I kind of hit the jackpot because the effect of COVID is that everyone wants to go to those suburbs. Everyone wants to be in those small town America is suddenly a happy place again. And it hasn't been for over 20 years.
Yeah, it's crazy.
Yeah. So, and I think, I look at school districts. I mean, that's really important to me, looking at the towns that have, they value their schools, they pay their teachers well. I mean, those are going to retain their property values really well. So those are also important factors, but I've been opportunistic in terms of asset class, I've been opportunistic in terms of geography. And I think that helps too. But people would tell me that I'm completely missing the boat. And oh my God, the South, the Midwest, like those are the only places you could possibly invest and earn an 8%, return or cap rate or whatever.
Right.
It's like, well, sorry guys, I'm getting 12 and 10 caps here. So you can enjoy your 8 caps, in 1,000 miles from where you live, but I'm improving my local community and I'm doing it, for profit. So that's my goal.
Yeah. And I think that's a great point. So I invest all over not all over the country, but we're targeted Sun Belt. And I do have properties in New England, primarily, actually just in New Hampshire, which to your point of people moving to, suburbs during COVID, the value of the units I already owned, the amount that they've increased is just insane, but it's the COVID effect. But the point of my question is, if you could talk on like why it's the benefits of focusing on one market. It's not something I do. I do focus a lot in Southern New Hampshire, but I also, our bigger properties, we buy in the Sun Belt. So Carolinas, Georgia. And, I've gone back and forth on whether, I should just focus on, one or two markets, especially a market that I'm really close to. Because I do see the benefits, but if you could just touch on that, I'm sure the listeners would love to hear that. Absolutely.
And there's no right answer.
Right.
That's the beauty of real estate is there's so many great and different ways to do it. I'm very geographically diversified within a small area of Maine. I'm not geographically diversified within the United States or internationally, although I do own a little bit of land in Bolivia and I own some passive, LP stakes and syndications in other states. But by and large, I've chosen to focus on driving distance from where I live, basically. And it's because I love seeing what we're doing. I love driving by a property that was an eyesore and seeing the physical improvements that our crews have made. So I think when you invest locally, I'll talk it up and try to convince people to do this because it's about the friendships you make. It's about the relationships you make of people that you can go and have coffee with on a regular basis. The friends, the fellow investors, the brokers, the contractors, even the tenants. They say don't make friends with your tenants. Like I have made friends with a few, and I've even hired one of them who works on our team now and still is one of our tenants. That's that awesome. Is okay in some context. I'm not saying do it with all your tenants, but there's a great sense of satisfaction of being able to be part of your town, of your local community, and to be known as someone who helps people there and helps, fix up buildings and helps, take care of tenants who maybe couldn't have found a place otherwise or things like that. It's great. People email me on a weekly or monthly basis of like, hey, my sister-in-law, my friend's looking for an apartment. Can you hook them up? Can you help? And I'm like, maybe, I'd love to, let's see, like, here's our leasing director, and we'll see what we can do. But it is very gratifying to be able to see your local cause and effect, but it's also a huge competitive advantage. I mean, brokers that I know
off-market deals,
they know I'm a great buyer, come to me with properties and I know the block, if that's a good block, I know the town, if that's a good town. And, that is something that is very hard to achieve if you're just like, well, I know Ohio's a good market. I'm just going to, throw my money there, whatever. And I'm not knocking Ohio or, Sunbelt, because I think there's a lot to be said for looking at demographics, looking at job growth trends and saying, yeah, that's a growing, aspiring place. If I had put all my eggs in the basket of Detroit, in the 1970s, which would have seemed like a very smart bet because the auto industry was, on fire and doing great, I would be broke now.
Yeah.
I think there are so many different ways to do it. I like Maine and New England in general because we are diversified. It's not just the shoe industry anymore or millinery business. I mean, it's so spread out, and it's not a, kind of one horse town where there's one big employer. And if you lose that employer, your whole business is down the drain.
Yeah. I think that just hits on the point too of, know thy market, be comfortable with thy market. And even if it's not going to be close, just really be intimate with it. Spend as much time there as possible, right? Going to different areas. Just the cool thing about, for me, of real estate is like the gut feeling. Like you just know when you're driving by, walking through a part of town, you just know if that's where you want to invest or not. Or at least for me, that's something that, I feel when I'm in a market. And I do see the benefits of investing local. Like obviously I'm assuming you're going to see a lot more off-market deal flow than some random guy coming into the market just because you're well known and established there. Yeah. And so I think it's a great point. And I also love other markets too, because, it's from a diversification standpoint, right? So like you said, there's diversification within New England. And then as you go out there's even more. But I also want to hit on, you mentioned that you have investors and that's how you've been able to scale. If you could just talk on that and how you've been able to grow your investor list. Is this primarily JVs, syndication? What does that look like?
Yeah, great question. Started out as just family, and then it, kind of the circles expanded to friends, work colleagues, acquaintances. It's mostly your personal network to start with. Now I'm starting to get introduced to people, from being on podcasts like yours, from friends of friends of friends, and things like that have, but the biggest thing, you can do to attract investors, if that's something you want to do. And I know a lot of people that isn't right for them. They want to just be in absolute control, 100%, do their own thing and not owe anyone a quarterly report or any form of due diligence. And that's fine, especially if you got a lot of your own capital, go for it. But there's the saying, if you want to go fast, go alone. If you want to go far, go together, something like that. And I've definitely chosen that team-based approach. So, I would say 2/3 of the investors are people that I, knew personally. They're now really getting to be friends of friends and others. And I have phone calls, Zoom calls with them, and, coffee, beer, et cetera, and get to know them. And ultimately, I mean, the biggest factor is just me being a trustworthy person and always putting their interests and savings ahead of my own, desire for profit. And that can be a win-win. They know that I make money when I do a syndication, and I'm completely transparent about, what money the sponsor or sponsors, because I've co-sponsored things too, are making. And what they'll be making. And if I can offer them, a 15%, annualized return or greater, they don't begrudge me, the extra 2 or 3, that I would make on that. And it can be a win-win, but, it's always a hope and a goal. Like we've been in a very easy market to make money right up until about now. And it could be very hard to make money in the next couple of years. It's hard to say. No one has a crystal ball, but we get to look good for now. Like, oh yeah, all my units that I bought even 3 years ago have doubled in value, and we're refinancing. I mean, I refinanced probably 2/3 of my portfolio recently, and not all of them had even run out of their original loans, but it was just so obviously the right time to do that in the last, 18 months. And I still think that applies. I mean, you've got this little window here where rates are half of their historic averages. And I think there is a chance they could go back to those averages or above if you think we're going into hyperinflation and, a repeat of the 1980s, which I don't, but either way, I think working with investors is fun because I get to show them physically what their money does. I love doing these before and after photos of like, here's the exterior of the building with rotting siding and holes in the walls and windows. And here it is now, 40 grand of your money later, it looks great. And the units are renting for more money. We're getting better, rents overall. And so, bathrooms, kitchens, all these different things that we can show investors. That's so different than you investing in Microsoft and be like, okay, Bill Gates or whoever's in charge now, like, great. You're not changing the world by, doing paper asset-based investing.
Exactly. And I think that's so true. It's like the image that you can show current investor, potential investor, that like, yeah, you're not only getting a solid return on this, but you're actually improving something. You can actually see it. And that's, from my experience, it's really powerful to show that. Because like you said, if you're investing in the stock market, you're not seeing anything. You don't like, you don't even really have any say in anything, and you don't really know what's going on behind the scenes. So I think that's a great point. And so are these syndications, JVs? You're doing a little bit of everything?
Yeah, I did only like I only have done JVs with my one friend and immediate family.
Okay.
I think those can get a little tricky because they're not as easy to govern, and there's more chance for power struggle or disagreement.
Yeah.
You know, in the fundamental thing of like, oh, it's me and three friends, but now I'm not really friends with one of them, or one of them wants to get out and the other doesn't. Like that can kind of blow things up and give people a bad taste in real estate. And I'm not saying don't do it. You also need to be very careful of SEC law. And
Right.
a lot of JVs are in flagrant violation of that
law.
law.
I would say probably 60+% of them are, if not more. So you all parties have to be active.
Right.
And I would even say, even to an extent, even if you have all active to a certain party, I would still, if you have too many, I would still consider it a security. So yeah, you have to be really careful.
Exactly. And so what I now do, for larger investments, if it's not with family or someone I trust with my life, it's a syndication. Yep. So we use, a law firm that only does syndications. We make an SEC filing in each state, where investors are coming from. We do it all by the book. And
506B or C?
506B. So we love, so here, I'll get on my soapbox here for a minute. I think the whole concept of an accredited investor is an elitist way for the wealthy to keep the unwashed masses out of the true wealth building asset classes that they know and love. And I think it should be abolished. I think it's wrong. I think if you allow, loan sharks and payday lending and credit cards and gamblings and Las Vegas, you've no justification to prevent a person from investing in a real estate syndication. None.
Right.
That's my opinion. So, we love taking non-accredited investors who get to dip their toes in the real estate waters. We only can take, I think it's 40 or 42. I mean, an attorney listening can write in and correct the exact
35,
number.
yeah.
35. Okay. So we're not hitting that number. We're getting 5, 10, 15, et cetera. Most of our investors are accredited, but I love the concept of being able to take non-accredited investors in an easy format. Cause that's how I started. I started as a non-accredited in my friend's syndication, in Minnesota, and I trusted him. I knew nothing about real estate. He sent me this family and friends offering that promised, or, hoped for like 20+% returns. And I was like, no way. That sounds like a scam. Good returns in the stock market are 7-8% a year. So don't tell me you can get 20. But I thought to myself, I trust this friend really well. I know he's not going to work with crooks. So even if they're over optimistic and they only do half as well as they're thinking, that's a pretty good investment. So yeah, sure. I'll give you my savings and try it out. Cause otherwise I'd probably just spend them. I was in my, mid 20s at the time, and it's probably the right thing to do. And it turned out to be a great investment, but I do think that passive real estate investing is a great thing. I think the move towards crowdfunding and sort of loosening the regulations is overall going to be a good thing. It does kind of create a more like stock-like atmosphere where like you're again kind of shotgunning your money out in different places and you have no control or whatever, but that's okay. I think that there's a lot of growth in the space, in prop tech, as we're calling it, and it's all exciting stuff. I'm kind of sticking to a traditional, one property, one syndication, LLC format that, has worked for a long time and is working for us now, but maybe sometime we'll change it up and do a fund or, do a crowdsourcing endeavor. We'll see.
Yeah, I agree with you. We do 506Bs for the same reason. I just want everyone to have a chance to get into this awesome investment opportunity. And like you, majority of our investors are accredited, but there still are a handful that are not, that want to get in. I love that. I don't know if you're aware, I was speaking to my syndication attorney recently. There's actually a new feature to 506Bs and Cs where you can actually start off as a 506B. And then through your raise, you can actually then switch to a 506C, that the PPM, which listeners, that's the private placement memorandum. It's the documents that, form the syndication, that can be changed to then a 506C. And then as of that date that it's changed, you can no longer accept non-accredited and you can only accept accredited from then on. But the non-accredited you accepted before that date can still stay. So it's kind of a cool way to still accept non-accredited, but then eventually market. But then I would say to listeners, it's only good if you really have a platform, because if you don't have a platform, like Dave mentioned earlier, people are investing with you because they know, like, and trust you. So if you don't have a following, to me, it's kind of pointless to market, because there's so many good deals out there. Why are they going to choose you just because, you put together a flashy marketing piece that says, hey, look at 20% return. So that's kind of my soapbox on that. But
Yeah.
there's also some cool things. I don't know if I want to say cool. One of them's cool. One of them's not really. But I heard, and this, listeners, this is just hearsay that I've heard, so who knows if it has any legs or anything, but they're talking about changing the accredited investor guidelines or rules. So the net worth would go up to 10 million from 1 million, which it is right now. And I can't remember what the income would go up to. I can't remember if it's like 400,000. And then they would allow you to take some like online exam or quiz to become an accredited investor if you didn't meet those guidelines. So we'll see if any of that actually happens. It just helps those that are already in power and have wealth. That's all that does. But there's actually a cool thing. I'm not an NFT person by any means. I do like blockchain, though. I can see the benefits of blockchain. And again, my syndication attorney was telling me that in the future, there's been some talk that possibly creating an NFT out of an LLC. So like a syndication LLC, where your share of that LLC, which that's how you set up a syndication, you own a percentage of an LLC, which then owns the property. You would have a share of that LLC that's an NFT, so then it would become more liquid. So right now, usually you have, say it's a 5-year hold, usually your money has to stay in there for 5 years. And in this circumstance, you could actually, trade on an open market, so it'd be more liquid. The only caveat to that is, like, you as an operator and sponsor, how do you know who's coming in and whether you want them or not? So that's the only downside to that. But the upside to it is, it's more liquid for the investors. So we'll see if any of that happens, but I just wanted to let the listeners know that's what I've been hearing.
Yeah, that's all really interesting. I got excited about cryptocurrency back in 2016, started dabbling in it. I wish I had dabbled much harder than I did, because the dabbling I did do is up like 1,000%, but 1,000% of $50 is not going to, change your life or whatever. But I do believe both in the currencies and I think the blockchain, the NFTs, I think that whole space is one that real estate investors should pay attention to, because it's like poo-pooing the internet, back in the 90s. You can fight it, but it's coming whether you like it or not. I'm not saying you should put a ton of money in it and gamble, because it's another example of something like, I'm allowed as a non-accredited investor to put all my life savings into Dogecoin, which some people actually did. But I'm not allowed to invest it in Shawn's like 100-unit multifamily building in a good growing market, because Shawn's is too risky for me. That's dangerous to the investor. But Dogecoin, no, I can liquidate everything I own and put it in there. Like, give me a break. So I would just say we're either going to let people, be adults and invest in whatever they want, or not. But this in between where we are with the accredited investor status is to me unethical. And I think raising those thresholds, again, that is the opposite direction we should be going in. We should be protecting consumers. I'm all for that. I'm all for rooting out fraud. I would add a lot of investigators to the SEC and IRS and all the other places where you need to find criminals doing things that are illegal and stop them from doing it. But to prevent people from investing in profitable assets just because there's a small chance it might be a Ponzi scheme, that to me is not easy to police and a good way to do it.
No, I agree with you. So let's talk about the future. What does Dave see, and where does he want his business to go?
Yeah, man. Thanks. That's I don't know. Being opportunistic, I haven't planned out my roadmap as scrupulously as one might, but we are working on a new construction project, which is really exciting. That'd be about 60 units in an opportunity zone.
Oh, nice.
In Brunswick. We're in the kind of permitting feasibility stages of that, and it's going much slower than I would have liked. As someone, as Grant Cardone described it, you can either, fly in an airplane across the country, which is the analogy of buying an existing property, or you can build your own airplane to then fly across the country, which is new construction. And that's exactly how I'm finding it, where, yeah, it's much harder to build your own airplane than it is to just get on an existing one. And so I'm continuing to acquire, existing property, because the, price per square foot, the unit count and so forth. I mean, there's just a night and day difference, but it is exciting for me to be able to design something right from the get-go that I'm going to stand behind and is going to last for hundreds of years after I'm dead and gone.
That's legacy,
and it'd
right?
be a great home for people, like that's really exciting. And I think there's, profit reasons why you would do that too. So that's part of the future, is doing some new construction, development projects, and, expanding the team of people we have here in Maine to keep working, in property management, keep working with more refugees, placing them into units, doing things like that is what we're up to.
That's awesome. I love it. And yeah, the whole, I've looked into development and always been interested, because that's like the sexy part of real estate, right? You're creating something out of nothing, and to your point, you're building a legacy, right? Because it's going to be there way after you're gone, or at least hopefully it is, right? And yeah, that's always been top of my mind. I just try not to get the shiny object syndrome, but it seems like you've mastered that, though, being opportunistic and being able to kind of bob and weave.
Yeah. And a good example of why on earth do I think I'm qualified to do a new construction, investment that's, 4 times bigger than my current syndications, which are pretty small in the grand scheme of things. It's because I'm partnering with my best friend, from Carleton College, who took those architecture classes with me, except he went and became an architect. He worked for developers. He's been, a GP for 10 years doing, he's done over 3,000 units of new construction in Minneapolis. So he knows new construction like the back of his hand. He's got over 600 units, going up right now. So awesome. He's, the brains of the operation, and I'm the local, boots on the ground, and that's a good partnership. And I'm learning a ton. It's been a really fun process to be in these, Zoom meetings with architects and engineers and others, learning, about all the nuances of new construction. But it's an eye opener. I mean, it is not the easy path. It is definitely 100 times harder than just buying an existing building.
Yeah, well, it's that whole risk reward ratio, right? So like, you're gonna take more risk, but the reward potential is a lot greater than buying something stabilized. And then to your point of, partnering with your friend, it goes to the who, not how, the who, not how. It's not how can I do it? It's who do I know that knows how to do it, that I can partner with, that can fast track it and make my life easier and, hopefully be way more profitable. So I think listeners, anything you want to do, whether it's in real estate, any aspect of real estate or anything, don't always look at it like, I need to figure out how to do this myself. It's like, no, find who knows how to do it and either partner with them or, learn from them. And that's, in my opinion, the best way to do it. Well, Dave, thanks for your time. Before I let you go, first, I have 2 questions that I always ask, and then also I'll get your information before you leave so the listeners know. But first, two questions. First is, why real estate? Like, why is it as an investment vehicle, and how has it changed your life?
Why real estate, is a multi-part answer.
Yep.
And, the best part for me is that it is so tangible. It is so real. You can go and physically improve the value of your property by putting, sweat equity into it when you're starting out. That is really special. You can't do that with Apple stock. I think another why real estate is it's always going to be necessary. It's not going to get obsolete. It's, there's always going to be a need for housing and business property around. I think it's a great hedge against inflation. I think it's a great way to short the dollar. Is you're borrowing at a fixed rate during a time when the dollar is depreciating at an unknown but very high rate that's much higher than the rate you're borrowing at. I mean, that is a good trade. So I think there's a lot of great reasons, and you can make your community a better place.
That's awesome. And yeah, I always hit on that inflation point to the listeners, so they've probably heard that a few times. It's, especially right now, it's just crazy. All right, last question. If you had a time machine, if you go back in time and talk to your younger self, and you could give them one piece of financial advice, what would that be?
This is after killing Hitler. I would then go and give myself some financial advice. in my time machine. If I only get one visit and I have to go to myself, here's what I'd say is, I think growing up, I was very, idealistic, which is not a bad thing, but I certainly had a negative stereotype of landlords, which meant that I had no interest in real estate because I thought landlords were kind of greedy and, bad people or whatever. I had a, untrue prejudice. And I would try to erase that and say, hey, this is a field and an area that you can learn about and get involved with and do great things. You don't have to fall into that stereotype. And in fact, quite the opposite. You can change people's lives in such a powerful way that makes much bigger difference than just donating to the Red Cross or doing something kind of at arm's length by being a good landlord to your tenants. And frankly, I would also say, and by the way, dude, it's 2009, buy everything in sight, max out your credit cards, do everything you can to get into real estate then. Cause I only got started a little bit in 2013 and really got the engines going in 2016, which is in retrospect, perfectly fine. But
still great. Yeah.
If someone could have timed the market perfectly, you would have known that, 09 is really the time to put the pedal down and start buying.
Yeah. I wish we all had the time machine to go do that. Right. Yeah, I would have started buying stuff up in Boston when I was there because you thought it was pricey then. Well, it's nowhere near it is now. But yeah, that's the if game that we always play. Well, Dave, thank you so much for your time. Before I let you go, where can the listeners find you?
Just give me a call, 207-517-5700. My website is holmanhomes.com. Emails dave@holmanhomes.com. So I'm not so famous that I'm hiding and people rarely take advantage of the contact I just gave you, but I'm happy to meet any of you. If you have questions, happy to give you a few minutes of my time and get to know you.
That's awesome, Dave. And that means a lot. And for those listening, actually take him up on that offer that you're going to get a lot of good nuggets talking to him.
I'd love to be inundated. I've usually get like 1 or 2 or 3. So if you can be free, that'd be like amazing.
Yeah. I think a lot of people are usually too afraid, but the only way we grow is by stepping out of our comfort zone. So make that call. But Dave, thank you so much for being on the show with us today. You gave a lot of awesome information, a lot of actionable steps that people can take. And listeners, if you got anything out of this, it's, that you don't have to go alone, reach out to your network, look for mentors, partner with people. And like Dave said, that's how you can fast track everything. So, all right, Dave, thanks.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.